great to have you both with us. And Michael, kicking us off, how would you describe the state of the global economy and what's the case for international equities given the current environment?
So, I mean, last year when I gave you Outlook here, it was actually much easier for me because we were at that time, we were early believer in the mRNA vaccines and the potential success. No, now we have vaccinated a good part of the developed world. And if you look at Israel, UK, and US were in the forefront, but by now this picture has totally changed. I mean, we have now a lot of other countries even ahead of the United States. So if you look at Singapore with 78 or Germany is 65, and even late adopters like Japan is around 58% on the first dose. But in order to get ahead of this kind of pandemic, we have to catch up on the emerging market world and make the vaccines available and affordable for these countries. And India probably is a positive standout with 36%. But we have to continue working, and that is very, very important for the overall outlook for the overall equity markets worldwide. So there are worries, definitely worries coming up here in quarter four. And one is, of course, still the COVID because of the Northern Hemisphere and breakthrough cases. But I think it's encouraging that many countries are now finally going to the point where they say, I can live with a virus as long as hospitalizations are low. And I see that more and more adopted by more and more countries. But the other worries is clearly is the inflation, right? And that is particularly painful. And there are several reasons for the sharp rise in inflation. Number one, of course, is the sharp recovery. So it's a big V-shaped recovery, and the supply chains were not ready, not prepared for it. And I think it will weigh into the quarter three earnings, but it should ease the more we go into 2022. The other part is energy prices. And they were skyrocketing, and here in the US, we haven't really noticed it as much. But if you go into Europe and Asia, we have skyrocketing prices. And I think they will stay high for some time due to the economies which are coming back on stream, needing more fossil fuels. And therefore, we need some time in order to have a supply response. Give you an idea, China, I mean, they just started talking about buying LNG at any price to be ready for the winter. So there could be even a little bit further of a spike in fossil fuels. And that might weigh a little bit on the equity market. So, and thirdly, is the labor market. So here, we probably stay with elevated levels for a little bit of time because many countries have quite some tight labor markets, and some of them have introduced or increased minimum wages, which cause this kind of spike. So from that side, inflation will be elevated for a little bit and will ease further in 2022. But it will also mean that central banks have to react on that because inflation and strong GDP growth will force the hands of the central banks that will slow down easy money policy or increase interest rates. And some markets have actually adopted that already. So if you look into Norway and Czech Republic, and the BOE likely to follow. The Fed, we hear it in every single day, is talking about tapering, and the ECB likely will reduce the asset purchases in 2022. But don't be fooled. The balance sheet of the major central banks is not shrinking. It's still increasing, but by a smaller amount. And higher interest rates and tapering of financial and fiscal support will cause volatility and potentially slider equity markets in the short term, in particular when we go into the earnings season. But from my perspective, as long as interest rates are not moving up sharply, equity should look actually okay to good. Inflation, what it does in the equity market, it delays, with a little bit of delay, higher revenues will come. There will be passed through, and if you have some pricing power, it will end up also in net earnings, which then will be almost like a wash, and you will have a kind of inflation protection. So let us also think about what are the other parts, right? Are the consumers still in good shape? And the US consumer being the most important in the world, as it is the largest consumer market. So we had savings ratios in the United States accumulating a lot in 2021, and we have spent good amount of that in quarter two, and we're still higher than we were in 2019, but not as abundant savings as we used to have. And I think Europe and Japan look a little bit better there because they came late out of the tight COVID restrictions and will probably spend a little bit more. Service sector is particularly interesting from that perspective. So if I look at the other potential stress factors in the market, and I don't see that much on the default side, I don't see that much on credit spreads, and that would lead us where we are in the recovery. And we have passed already step number one, which normally is share prices go up a lot, earnings initially recover slowly, multiples expanding, and then we go into step number two of the recovery. And I think we just finished that one where earnings multiples are not expanding anymore, and or might come down actually a little bit, but earnings are growing at a very fast pace. And we go into phase number three now, and that is a more of a critical or mid-cycle or late cycle, where the question is, will the multiples hold when earnings increases are only modest, right? And if we look at earnings increases now, I mean, we had a phenomenal 2021 where we had like 45% earnings growth. It's really mind-boggling. But when you look into 2022, consensus earnings are somewhere around 8%. US is smack at 8%, UK because recovered earlier, a little bit slower in 2022, Eurozone opening up a little bit later, 9.5% for next year, and Japan at 8%, which is a very good level for Japan, and emerging markets are just at par. But I think that does not necessarily compensate for the risk or volatility which we have in earnings.
Yeah, and it's so funny, Michael, going back to your first point, I think a lot of people said, "Oh, well 2021 will be easier to figure out than 2020," but here we are, Joe.
Yeah, Joe, I mean, I do agree with that too. I mean, supply chains will probably change globally, and very critical, important pieces of the supply chain might be onshored again, and you will see them, whatever, in the US, Europe, and Japan, without any doubt, because I think we all learned out of this lesson. Also, particularly on the pharmaceutical industry, we cannot be all dependent on Indian vaccine manufacturing. So it's a very good point.
Michael, turning to you, how are you taking a broad and diversified approach to finding growth opportunities?
Yeah, so indeed, I mean, we're bottom-up investors, we're growth investors, but perhaps in order to put that into perspective, I just want to introduce you very quickly so the way how we are thinking about our strategy. So the overreaching goal of our strategy is to deliver above market return with market level volatility. So in short, it's a good risk-adjusted return. And we're investing clearly in quality growth companies, which are trading at a discount to the intrinsic value. This is a very nice sentence, but just to put a little bit more word around it, the discount, which we are talking about, is the one between market expectation or consensus and our analysis. And there we see some mispricing, and they are very often coming from two things. One is the duration of growth, and the other one is the magnitude of growth. And in order to capture as many opportunities and still delivering somewhat around market volatility, we came up with an approach of our three buckets. And I just explained them very quickly. The first one is probably the one where everybody says, okay, this is a typical growth investor. We call it emerging growth, and we put up to 20% of our money in there. These are the companies which are growing extremely fast. They have large addressable markets, and they're very often these kind of disruptors in their respective sectors. Not very cash flow positive, but what the market does here, they underestimate in these companies the magnitude of growth. And then we have our second bucket, which is for us the bread and butter business for growth investors. And we call it the secular growth bucket. We put 40 to 60% in there. And these names and companies have very long duration often in our portfolio. And these are the ones which are still not growing that crazy as our emerging growth bucket, but they're still growing nicely above GDP. They do have very strong cash flows. They have good management. And they are normally delivering superior returns and compounding the profits year by year by year, normally relatively lower volatility companies. And the last bucket, which helps us actually to gap a little bit the kind of shifts between value and growth, which we call structural growth, are companies which are just GDP growers, very often out of favor. But we see somewhere that earnings are growing, and we see also a trigger to unleash this kind of value. And we put 20 to 40% in these kind of bucket, which is called for structural growth. So that's in a nutshell how we look at our approach and how we define growth.
Michael, any disruptive forces that you've identified in international markets?
Joe, perhaps adding on to your analogy with the cars, right? I mean, I do agree. I mean, you want to have your best ideas in the portfolio. That's what we are also looking for. But we are not as concentrated as you guys. We're somewhere around 50 and 70 holdings in our ClearBridge International Growth Strategy. But for us, it's we want to put our best and most racy ideas into the portfolio, but we want to also think about market risks and whatever. And for us, it was 50 to 70. It's not that we get the car which is taken out of the curve. So for us, 50 to 70 names is our electronic stability system in your car analogy. So.
Well done, well done. Well, Michael, any disruptive forces that you've identified in international markets?
Yes, so disruptive forces, I think it's not only international markets, to be very honest. I mean, disruption is honestly, it's global in nature, and it has to do something with technology and digitalization. And that happens in so many sectors to a different degree. And I had always one rule in my life when it comes to disruption. You want to be investing with the disruptors or the ones which are using this disruptive technology and avoid the disrupted industries. So why is that? And disruption is at the very beginning is very often misunderstood and underestimated. And in our digital world, which we are living in, the computers are getting faster, the data is available left and right, and the cycles of new invention and disruptions are just increasing. And so you will be consistently on the lookout for the next big thing. And adoption is also getting easier nowadays because most of that is software driven. And it's easier to configure today with any kind of APIs where you add it to your existing system in the company. And if you look at the disrupted industries, what is their biggest mistake? They're often very slow to react, and most often they do not want to kill their cash cow. And there might be other reasons, perhaps lobbying of politicians or labor laws or whatever. But the disruptors on the other side, they're fast and without any mercy. And the last one is what makes it so powerful is the emergence of venture and private equity. They give them long-term capital and a lot of firepower. Have in mind, I mean, this segment, alternative capitals, growing by 10% per year. So for the disrupted guys, it's either adopt or die, right? I mean, I'm a little bit extreme here in the explanation, but if you look at how far these kind of disruptions can go. I mean, we know about the electric vehicle, right? Everybody knows the Tesla story, but it's going consistently higher every year. And if you go to China today, we're talking about 10% of all new cars being bought are electric already. This is way ahead of any other major economy. I mean, Norway might be the exception because of all the incentives and so on. So the incumbents have to think about it. What do I do? Merge, sell, or die, right? I mean, that's what it is. And VW, GM, and these ones have definitely adopted. And the next level, in addition to the EV and for the car industry, will be autonomous driving. I mean, it is a little bit quiet about it currently, but there are consistently improvements and improving AI, faster computer speeds. Will change at one point the behavior, how we use a car, and that will mean that we end up probably more with ride sharing or fleet usage. And that means less cars, which will be more heavily used. And then potentially trucks at one point will run throughout our country without drivers. And think about the implications, how much labor will be displaced. And the next one will be then the energy sector, right? I mean, if we go the route I'm talking about, an adoption curve of electric vehicle, and in conjunction with renewable industry, that will replace fossil fuel. And perhaps it goes actually faster than we think. And when you pair that one with battery storage, you will have even a more disruptive power. And that will set a lot of geopolitical questions for the energy dependent countries like Russia or the Middle East. So I, as another industry, which is really at my heart, it's the banking industry, which was very difficult to disrupt because of all the regulatory hurdles and capital requirements, which are very high. But the fintech companies, which are the disruptors, they try to attack one little piece of the banking business, which is the fee business, which is capital light, and with the use of technology, it can be very, very profitable. Um, so it's what I'm talking about is the payment industry, and which is consistently going more into the hands of the specialist players. So we have a company there which is called Adyen. We have it since the IPO, so we have it for years, and it's one of our emerging bucket examples. And these kind of companies disrupting the banks, which are still the major leader of the payment business, but it's a question of years. And what Adyen does and their competitors, they have developed a platform with superior technology, which offers the merchant and the client a better shopping experience. The speed of checkout is much faster. The decline of your credit card is definitely lower. And the last thing you want when you go shopping, I mean, a declined credit card, right? I mean, that's what it is. And then these kind of platforms are collecting data, and this data is incredibly useful for later on for advertisement or targeted advertisement to you via their merchant. And the pandemic has basically just accelerated the process of online shopping, as we know, and electronic payment. And in international markets, opposite to the US, we have a very low penetration of payments. And that's where the unbelievable nice growth of payment company comes. And Adyen has delivered a flawless combination of now online and offline shopping. And there are many more sectors. I could go on, and perhaps I mentioned a few of them, perhaps like big pharma, for example. Nobody talks about that yet. But there are a lot of small biotech companies which have incredible science. And when you look at the emergence of CROs and CDMOs, which basically is an outsourcing function in making drug development and manufacturing easier, cheaper, faster, and less risky. And when you look at, I mean, we know it now from Moderna and Pfizer BioNTech, these like new technology, mRNA, I mean, it's already around for some time, but they have now developed platforms, and if they can offer more vaccines and perhaps the platform goes into different usages like cancer or autoimmune diseases, which are huge black blockbusters for the major pharma companies. So this is very, very powerful. And the second part, which I said about, is adopting disruption. So if I look at AI, right, we have a company which is called Teleperformance, which is basically a call center with add-on functions, and they're using AI and train their chatbots. And now we have 80% of all calls can be solved through AI, and the number just goes up. Telemedicine will be the next one. Also AI, data use, and you had probably your first online doctor visit during COVID. Now, at the end of the day, it was not that bad, right? I mean, so we're just at the beginning. And if I talk about e-commerce, I mean, you know these, and we have one which a company which is called Ocado, which helps you to save a few hours of your week in grocery shopping. They are partnering up and give them the technology how to be prepared for online grocery shopping and delivery. So there are a lot of disruptions in real estate and whatever. I mean, I could go on for ages. And there will be one which I'm very much interested in the agriculture, where technology potentially will provide us with more affordable and less polluting food. And that would make us also less vulnerable to natural catastrophes. So it's a little bit of a science fiction movie here, but all of that stuff is happening, you know? I mean, so, and we have to be aware of these.
I mean, it's unbelievable. It feels like we're living in the future sometimes with all these technologies that you mentioned. And you're also invested in the renewable space, and that's something that you touched on. Michael, how should global investors be thinking about clean energy?
I mean, it will be in everybody's considerations, and all countries in the world, almost all countries in the world, have talked about carbon neutrality. So we have the Paris Accord, we have Europe with the Fit for 55. They give you all numbers, what they want to reach by a certain time frame, but there is no real exact science or numbers behind it how you want to get there. And one critical part of that will be the renewable energy. And for me, it's crystal clear that all the renewable pipelines which we have currently, right, are not enough in order to get there. And I give you a little bit of an idea how much that should be actually. So, and we want to go there replacing this dirty coal and in order to get to the CO2 reduction. So we would need almost 4 times of renewable, if it's solar, wind, offshore wind, or whatever it is, to get there, to get the intermittent milestone, meaning 2030, so 10 years. And this number would be 20 times if you want to go where we want to be in roughly 2050. So, and what is so powerful, and that is also one of these, I just talked about disruptive forces. This is another one. And if you look at what happened over the last 10 years, 2010, we had prices for renewable energy, which coming from onshore wind or solar, around 110 to 120 euro per megawatt hour. And the government had to support it with tax dollars. Today, it's very different. So we are today around 25 to 40 euros per megawatt hour. This is roughly 1/3 where we have been 10 years ago. And more importantly, renewables do not need subsidies anymore. And actually, today, electricity prices, and Europe is a little bit on the high side, US definitely lower, China also a little bit lower, but Europe is so high because of the high gas prices currently, somewhere around 60 to 100 euros per megawatt. So we're talking about at least half what it is currently. So it means renewables become more attractive almost by the day. And I wouldn't be surprised, Europe has it already, they have a CO2 scheme, that other regions will start introducing CO2 emission penalties. And whatever the regime will be, it will increase the price of electricity. So, and if you look at the Green Deal in Europe, it's around 10 trillion euros or whatever, almost $12 trillion. And 2.4 trillion goes into renewables and 1.8 trillion in transmission. And that's exactly the wheelhouse of EDP.
Michael, what are some industries or innovations that are best provided by non-US companies?
Well, we have quite some, to be honest. And I just for me, there are certain similarities with these kind of companies. So, and number one is these companies or sectors, they have a certain specialization in one field through science, technology, or whatever the uniqueness is. And number two is, as I do not have like a large home market that's opposite to the United States, they have to fight extra hard to get into the next markets. And by focusing internationally, you get even a bigger potential market than just the US. So, and if I give you a few examples, so we have one company called LVMH, very well known. It's in the luxury industry. This is now a global leader in luxury. And what is the uniqueness there? And this is the deep-rooted heritage of the brand and the great management which has built a luxury empire. It's not only anymore like handbags and whatever and champagne. It's going from all facets of luxury to travel and accessories and so on. And the management has really understood to build this platform, acquire smaller brands, and take them global. And that makes the additional add-on profitability of LVMH. And in spirits, it's a very similar thing. So companies like Diageo, which we also hold, And the US, we know, has good whiskeys and good bourbons now, no doubt about it. But outside of the US, there are many other spirits, right? We have very, very big vodka brands. Okay, the Scotch is there too, gin, tequilas, and like LVMH, Diageo has built a platform where they acquire other brands, put it on the platform, market them global, and that is their success level. And even like small areas like flavor and fragrances, and we own a company. It's called Givaudan. They came originally out of a big pharma company. There were nobody in this big pharma company, but they specialized, and through their deep-rooted know-how, they were able to become world market leader in there. If you look at skincare, L'Oreal, Shiseido. If you look at semiconductor hardware, right, and foundries, it's clear. It's TSMC, it's ASML in lithography. They're the undisputed leaders in their fields, and just one word on weighting of our semiconductor exposure. We were clearly overweight in semiconductors, which helped us. But we are getting a little bit more careful on semiconductors because we could see that there is a little bit of an over ordering right now because of the shortage, and then the semiconductor business, in particular on the foundries and on the providers like ASML, they have very little visibility and feel this kind of cycle a little bit later. And I think that the cycle could turn over or roll over beginning 23, and you want to be early. But there are many other ones like wind energy, which we talked in renewables. Vestas, Siemens Gamesa are two leading suppliers. Atlas Copco, fantastic company in compressor technique in Sweden, very small country, but they made it global. Airframe manufacturers, it's a duopoly, Airbus and Boeing. We think that Airbus has a little bit of an advantage right now, but I could go on with many more examples. But the pattern is very, very similar, right? So as I said, they have to be special in something. They have to be special and go abroad and focus internationally. Perhaps, Joe, I mean, we are also in banks invested, and our main banking exposure is actually in Europe, and it's normally not the most sexy sector for growth investors. You probably agree on that part. But as you know, we had, or as I explained earlier, we have this kind of bucket where we can put these kind of names in order to get a little bit more risk diversification, and where we see earnings increasing and there's a trigger. So we have identified the European banks, and when you look at them, what made us actually increasing our weight in European banks in over the course of 2021 is that Europe was actually the one where the regulator was the toughest out of all of them. So if you look at Australia was okay. I mean, it was a happy banking market to start with, and Canada as well. But the Europeans punished them because they were still thinking about the aftermath of the great financial crisis, right? So the result of that, as you just pointed out, I mean, these banks were totally overcapitalized and over-provisioned, and now we come to the trigger. So I think the trigger, and that makes you probably in your portfolio happy too, is the release of capital, which we most likely see now in October and December, and banks will start with the share buybacks and dividends finally, which we waited quite some time for, right? And the second part will be the provisioning, right? I mean, we had good provision releases for the last 2 quarters, and I think provision releases will continue for not only 2 more quarters, it will be more, probably 4 or 6 or whatever, but at a much slower speed. So if you put these two things together, actually EPS will look good, in particular because you reduce the equity, ROE will go higher. So I think this will be one of our holdings which will not stay very long in the portfolio. Once the triggers are done, we will exit that, but that's normally what we do with our structural bucket. Yeah, Joe, I mean, our point on China is also a little bit more careful, I have to say. We have reduced our exposure in 2021. And it's actually interesting when you said the Ant Financial was for you one of the trigger points. That was for me as well, because I cover financials and all the fintech space as well. And I saw also the disintermediation, and come to my disruption again,
Yeah,
but
exactly.
of Ant Financials and how much advantage they have because of the database,
Yep.
So I mean that was for me also one of these moments where I got very, very careful. Overall, I mean, China is an El Dorado for growth investors because there you have the growth which you don't find in some of the developed markets. But that comes with the risk of macro government interference, corporate governance problems, and so on. But it started already when we were really, really honest. I mean, it started already 2018 where they were just cracking down on financial leverage, and financial situation was pretty tight actually over the years, and they were cracking down on the wealth management products, and then the end financial thing, and then we had the Tencent gaming situation, education, and all the censoring, and that definitely led a lot of international investors which are in these companies. I mean, the rest, I mean, the locals are more in the cyclical stuff and whatever, and they felt it a little bit earlier. But but there's one thing which worries me a little bit over the next 1 or 2 quarters. It's not the whatever Lehman moment, but Evergrande is actually a pretty big problem in China. And if you look at the real estate sector itself, it's so important to the Chinese economy because it makes 25% of GDP. And secondly, it is the store of value for a lot of richer Chinese. They buy apartment after one after the other. And if the developers have problems, what do they have to do? They have to sell their land banks, they have to sell their finished apartments or repairing their balance sheet. That will have an impact on real estate, and that will have an impact on wealth effect, and that will have then an impact on overall consumption in China. So I mean, if I had to put numbers on it again, it would be somewhere between 1% and 4% of GDP growth impact, most likely on the low side, 1 to 2. But it will be felt, and I think it will be repaired somehow by the Chinese government. There will be plenty of liquidity flying into the economy, which is overall a positive also for other sectors. But the solving of Evergrande will be taking time, and it will be complex. So I'm a little bit careful for the next 1 or 2 quarters. But Chinese equities are cheap without any doubt. And we need basically, as you said, Joe, we need a little bit of a trigger where we see some indications from the Chinese government what will happen next. And but there's one thing which really made me thinking about China overall, with all these kind of intervention which President Xi did. What will happen actually with his spirit? I mean, the kind of entrepreneurship. Is this spirit now suppressed or not, or will it come back? And that is the one which made China so incredibly successful. One was cheap labor, but that's a long time ago. Now we're talking about entrepreneurship, and will that last? And you're right. I mean, there is a trade-off between profitability of companies and the social good for the population, huh? And that has to be shown in the next quarters or the next year. That's a good point, Joe. I mean, look, we're also conscious growth investors, and higher rates will lead to higher discount factors ultimately. I mean, that's what it is. And if volatility comes on top of it, then you have to discount your future cash flows with a higher number, right? I mean, fortunately, we have always taken already higher numbers in our models than actually you would get with a kappa model. But yeah, that can be very powerful. And if you're miss in the growth world with earnings, then you get penalized. I mean,
Yep.
there's no doubt about it. So you have to be extra sure, particularly sure to do that. I mean, multiples probably have to come down a little bit. That's what I tried to explain with the step number 3 in this um, where we are in the recovery. And so this is where a little bit of a worry comes and where the little bit of a wobble comes. But I think longer term, some of the ones which are delivering good free cash flows and have good management, these are the ones which are in our second bucket, secular bucket. These ones actually should do fairly well. There might be some derating, but if it's smart management coupled with good free cash flows, you can put it into growth, you can give it to shareholders, but it's at the discretion of management. And if they're good, they do the right thing.